With higher interest rates than they've ever been in years, finding new ways to purchase a home that works for both the buyer and the seller is more important than ever. Hey, I'm Tristen Campanella, and I'm going to talk to you today about a seller buy down method. It is a unique way to help the buyer and seller be able to come to terms and have the monthly payments work for the buyer and have the seller be able to also get the asking price they want. As a local real estate agent, my job is to create a winning relationship for both the buyer and the seller to reach a successful close of sale. And as always, I'm here to answer your questions, especially about this because it can seem a little bit unconventional and may or may not work for every situation. So please reach out to me anytime. Okay, let's get into this, guys. With interest rates climbing, home buyers are struggling to be able to purchase a home at the current asking price and with the high interest rates. So, how can we help the buyer and the seller bridge the gap in the price of the home? Well, we do this by offering a seller buy down scenario. What is that? Okay, let's talk about it. So the way we're going to do that in this example is the seller can buy down the rate for the home buyer, and then they can get the offer price that they want while they're still getting a home buyer lower monthly payments.
It's 9 o'clock.
Sound too good to be true? It's 9 o'clock. Well, it's not. And here's how it's going to work. So let's go over it right now. The interest rate that we're going to be using with no seller buyback on a home price of $1 million would be roughly 5.5%. So you can see this right here. And this comes from one of our home loan partners, and we can walk you through this a little bit more. So let's say that the buyer really needs to make a lowball offer because they really just cannot afford the monthly payment. As you can see right here, at this full purchase price of $1 million with a 20% down payment and a loan amount of $800,000 with an interest rate of 5.5%, then the buyer is going to have a payment of $5,625.64. So normally what will happen is the buyer will come in, give you a lowball offer, make a lowball offer because they really need to get those monthly payments down to be able to afford this house. So they're going to come in with, let's say, a lowball offer of $925,000. They're going to have a $185,000 down payment, still the 20%, so super strong on the lending side. Their loan amount is going to be less, same interest rate, but because the loan amount is less, obviously we're going to have less of a down monthly payment. But if we can get the seller to agree to buy down your interest rate in the form of credits to the buyer, which means that there will be no credits for any kind of repairs. So you really need to make sure that this house is in sound condition. But if the seller agrees to buy down and give you credit on the house and do the purchase price of $1 million, you still have your $200,000 loan amount, down payment, and you have your $800,000 loan. But now you can take that $20,000 and buy down your interest rate to 4.625%. So this win-win. The seller's getting the purchase price they want. They're giving you a credit towards your purchase back. Sellers are getting more money in their pocket because look, this is not $75,000 more than if they lowballed you. And now your monthly payment is even lower than the lowball offer. The difference you're saving is $429 versus the full price offer. Guys, it's a win-win. We have an opportunity then to be able to offer a full price payment to our sellers, full price offer, and help our buyers with getting a lower down payment. So it can sound a little complicated and you may not get the entire $20,000 down. Obviously on a less expensive house, we're going to get less money because we'll need less money. So make sure you're reaching out to me about how to make this win-win situation work for you. My contact information is below, and if you like the videos I make, I'd love it to see you subscribe, and please leave a comment below.